are going to dive into market insights with Fed meet, equity predictions, dollar index, gold, silver, and sentiment observations. Hello, guys. This is Shilpa Raidas, and we have Jay Vora with us as always. Hello, and welcome to you, Jay.
Hi, how are you?
I'm doing very good, Jay. How are you?
All good.
Wonderful. So, Jay, there seems to be a lot of data points lined up for this week. And then we also see that we have the Fed meet next week. Yeah. So, what is to be expected out of this, Jay?
Right. So a lot of events are lined up this week. In fact, we even have the RBI meet. So the reason why we don't talk much about the Indian event is because, they are very much stable right now, and there is no major, unexpected things that are happening in the Indian economy or the domestic economy. So the reason why we are talking more about US is because that's where we get to know how the interest rates are going to move, and interest rates movement is very helpful to understand how the other asset class will behave. So yes, a lot of data points are lined up for this week. Okay, the major ones being the non-farm payroll. I think that is going to come on Friday. Then I think next week we'll have a CPI print as well. Before the Fed meet, so that will be closely tracked as well. And if we in general see, okay, the US economy seems to be cooling off. Okay, so while the GDP print we saw this time was in north of 5, I guess, but I mean, one should not get carried away by that. But if we see any of the indicators, like just 2-3 days back, we got the new factory orders. Okay, that is in minus, that is in contraction, which means that the growth is negative over there, right? Yesterday we got Jolt survey, which means the job openings in US. So even that is declining. So obviously, the number of openings are still high, but it is on a declining trend. Okay, so there are many things that are suggesting that the things are cooling off in US indices, and that means that the rate hike which the Fed has done, that is now I mean, some sort of effect is being felt in the US economy. And that is why, if you see the tone of the Fed, they are saying that they are more or less done, with the rate hikes. In fact, even in the coming event, they are likely to pause only. And the language will. So the whole point is that market is trying to think how the Fed will, communicate to the market, because right now, see, there is a disconnect between what the market is expecting and what the Fed is doing. Okay, so I'll come to it. See, the market is expecting that there will be a rate cut probably as soon as the March month or in the July month. Okay, but the Fed is saying that they are likely to keep the rates higher for longer. Okay, so that is where the first disconnect is, right? If we go by what Powell has said, the Fed Powell has said, and he has stuck his gun, despite whatever was happening. So he had earlier indicated as well, keeping the rates high at this point of time. I mean, if they keep the rates higher for longer at this point of time, it will cause much less damage, because if they preempt and they start cutting the rates and inflation again comes back, then they will find it hell difficult to bring inflation back in control, right? So one thing I am very much clear about, and I feel that is how things may play out, is that if nothing breaks in the US economy, okay, the rates will be kept higher for longer. Okay, the only possibility where the rate cut will start happening is when something breaks, and you get some black swan event or something of that sort, and that's where the Fed starts cutting the rate. So in fact, I feel that if the rate cut does happen, it might be due to break of something, and which will not necessarily be good for the market, which right now the markets are anticipating. right? So I feel that there is a disconnect between the market. Okay. So right now, fundamentally, something else is happening. Technically, the something else is happening. So we'll come on the technical aspect in a while. But yes, this is how fundamentally things are. Uh, there seems to be a slowdown. Okay, we need to see how the non-farm payroll comes, how's the unemployment data that comes by, and more importantly how the CPI is. Okay, if it is it is somewhere around 4 or so, the core inflation, that also needs to come down, because the Fed, remember, the Fed is targeting 2%. Okay, it is still well above that mark. So if the Fed has to get it to the 2% mark, which it has been repeatedly stating, it will need to keep the rates higher for longer. And that may not necessarily bode well with the equity markets in the medium term, right?
Okay.
So yes, so that is how the scenario is fundamentally for the US indices.
Okay, that brings us a lot of clarity. Thank you so much for that, Jay. The next question for you would be, Jay, how are the equity markets in the US and India right now? And is there a risk of a correction in the short term or medium term? Also, your vision, your view on the dollar index, gold and silver, Jay.
Yeah. So here we come to the technical part, because a lot of the moves are happening due to the technical reasons. Now I'll quickly share with you the screen. So recently, yesterday we wrote a piece on S&P 500 and what is happening with the vol PCR. So this is very much similar to what we even do it on strike for the Indian market. But over here, basically the red parts, the red circle thing that you see, it typically indicates a top in the market. Okay, now that can be a short-term top or a medium-term top. Okay, but it means that there can be a correction around the corner. Okay, but one thing we have been repeatedly telling earlier as well, these data points throwing you a red flag and the price actually reversing are two different things. Okay, what is happening right now is that these all we'll discuss the data points. So some of the data points are throwing us the red flag, but so far price is not confirming, right? So we'll come to the price part as well. But as of now, when we look at the S&P 500 and the volume put call ratio of that, so over here, it is coming to that 0.9 mark. Now, typically it can also come back towards 0.8 or 0.85 as well. But over here, once this ratio starts turning on the upside, okay, and we see the equity markets breaking the 20-day average, okay, which I'll show you the chart as well, then that's where we are setting in for a correction. And the reason specifically why we thought about this was because when we look at the S&P 500 index over here, the daily RMI has gone in sell mode. Okay, the only confirmation now, again, this is something that it is showing a red flag, right? But a break of the 20-day average will be an initial confirmation to start thinking of a correction. Okay, because broadly, people who have been following us, they know that in S&P we are considering this as W, X, Y, X, and Z. Okay, if that happens, then this is a bigger corrective pullback. Okay, which means that there will be two outcomes: either there will be some sort of triangular pattern, or it can be a retest of the September low. So we don't want to get too ahead as of now, and basically we'll try to go level by level. But as of now, in the very short term, we are watching out for the averages very closely. Okay, and that particularly because the daily RMI has gone in sell mode. So if the 20-hour breaks, then that's where we can see some correction in the US indices, and also you will see this ratio also inching. So that means that again, US indices can get into the corrective phase, right? So that was on the US indices. Now, before coming to the Indian indices, I just want to speak a little while about the dollar index, because again, that is at a very important point. So when we look at the dollar index, we had mentioned this, I think, in our last interaction, that it is for now taking support at the 61.8% retracement mark, right? And today it is giving a sign that maybe the 20-day average will be broken on the upside. If that happens, then there will be furthermore up move towards the blue line, which is the 40-day exponential average. And if that gets taken out, then even the upper band, the upper Bollinger Band, will also be tested. But there was one alternate that we are thinking, that if, see, this can also be a running sort of triangle. Okay, visually, people might not be able to relate, but this can be a B, C, D, and we get a one more new high over here, and which becomes E, and then this becomes a decline in major A, okay, and we see a major B, and then we see a decline, okay, which means that if at all this move comes on the upside in E of the triangle, then that's where equity markets can see correction in the short term. But yes, that's about it. I mean, we get some healthy correction, say for a few days or few weeks, and then we again resume the uptrend. So that is what we are thinking as of now. Okay, now we will translate into how it should play out in equities as well. But yes, in the US index, like I mentioned, once this breaks, you'll start thinking that the 40-day average will come into play, and if that breaks, then lower band will come into play, right? And if that also breaks, then we'll see how things unfold at this point of time. But yes, over here, this is giving us some red flag. Now, like I said, dollar index turning around from 61.8%, is an important thing to watch out for. So until now, until and unless this low doesn't break, there is a risk of an up move in the dollar index. Maybe it only does a retracement of this fall and then eventually go down. But we should also be open to an idea that it can form in wave E as well on the upside in a running triangle. So that is on the dollar index. Now, honestly, gold and silver has been a little surprising, because if you see gold, it has made several attempts to break out from this range. One was over here, second over here, third over here, and this is fourth. And each time, actually, there has been a very big spike, and then it has gone down. But I think that if we see the higher time frame, which is the weekly and the monthly charts, they over there, the momentum is in bullish mode. So I'm very hopeful that this time around gold breaks on the upside. But let us see. I mean, if we get a negative weekly close, right? So right now we are still in the weekly, the week is still on, right? So on Friday, if we get a negative weekly close for gold as well as for silver, right, then these high will then become very important swing highs. And if these high doesn't break, then gold silver can get into trouble. Okay, now in the short term, what I'm watching out for very closely is the daily averages, right? If this is an impulse, then ideally daily average shouldn't break. But if the daily averages break on gold and silver, then like I said, probably they can be in some trouble. So we need to see how things unfold over there. But yeah, that is on gold and silver. Now coming to the Indian indices. So what we saw on S&P on the daily chart, right? This is something that is happening on a minor scale on the Nifty chart, which is on the hourly chart, which you can see over here. It has gone up, and now the prices are still at the higher levels, but momentum seems to be fading, and there is a negative divergence that is visible on the hourly chart. But over here again, what we will do is that we'll wait for the price confirmation. The 20-hour average, which is right now at 20,794, that will be the initial sign where it can see a correction. But to be very honest, in the Indian indices, I think there will be a pullback somewhere till here or maybe this gap area get filled at the max, and then eventually we may head higher. Now, the reason why I say that is because, many of the sentiment indicators are still not very alarming, and we'll come on that part, at a later stage. But yes, for the Nifty index, there is a chance that we see a minor correction, probably till the 40-hour average or so. The 40-hour average right now is around 20,544. And again, remember, it will keep rising higher as each candle passes by, because it is an average of 40-hour candles, right? So that's on the Nifty index. Now, in the Nifty index, from a medium term perspective, there are three alternates that we are keeping. And honestly, because the situation is so evolving in the US indices, because if we look at the US indices, despite the prices rising higher, okay, many of the hedge funds are still negative, and they are still sticking to the call that there will be a recession in the first half of US. And things can probably get ugly during that time. So ugly meaning that, there can be a correction in the equity market. So that's why, we have kept all the alternates open. Okay. Now I'll explain you each of the alternate. So one is that, see, this is the, so I'll tell you the three cases which we are thinking of. Okay. One is bearish, one is mildly bullish, and one is extremely bullish. Okay. So the first part is that if we take the bearish count, okay, then it would mean that this is an ending pattern in wave fifth. Wave fifth is usually an end of an up move, okay, which means that the rise which started from the 2020 low, this would be the fifth wave, and it would mean that, we can get a bigger correction in the weeks and months to come. Now, this is the first case, right? The second case is that something has ended over here, okay? The rise has ended over here. The correction ended over here. Now, this is a start of a new trend, right? And within that, the wedge-like pattern that we see is actually a leading diagonal. The reason why we say this is a leading diagonal is because the highs and the lows are overlap, but still there is a case that we can mark impulse within each wave, right? So if it is the leading diagonal thing, which eventually the rise from year to year, I mean, wherever it gets completed, that is the point from where the correction occurs, and we only get a retracement of the leading diagonal. Okay, which means that over here, even if the correction happens, it can probably come back to 19,000 or maybe a little lower than that. And then again, it starts rising higher. The most bullish scenario is that this becomes 1, 2, 1, 2, 3, 4, 3, 4, and 5. In this case, actually, the correction doesn't unfold only. Okay, and it keeps rising higher with some minor correction from time to time. Now, we are keeping all the alternates open at this point of time because, like I said, that, if US manages to pull off a soft landing or, no recession at all, then maybe the third wave, which we are anticipating, which is a very bullish outcome, that can come into play. But if we see a recession in US, okay, but not a very, hard landing or so, then what happens is that we come to that moderate bullish outcome, which means that the rise is leading diagonal and we see a pullback, and then eventually things start picking up. The bearish case is when that there is a hard landing in US and, something breaks, and we actually see a much deeper correction in the days to come. So, all these three alternates are open. As of now, we are just watching the data and we are just watching the price action to decide, and we are not going too far ahead and thinking that what is going to happen. If the daily averages break, that's where it will be a warning sign that a correction can come by. But as long as the daily averages are holding, there will be minor corrections in between, but eventually we should be headed higher, right? So this is on the Nifty index. In the small and the mid caps, we have mentioned earlier as well. Over here, actually, we can see a non-overlapping 5 waves, right? So over here, the thinking would be that once the rise is complete in fifth wave, we should be seeing a meaningful correction, okay, which can last for a few weeks and few months. And then if people say, then why not in Nifty that you are anticipating? And it's actually because, see, all this while Nifty has underperformed small and mid caps big time, right? With the state elections being won handsomely by BJP, now it means that most likely in 2024 BJP is going to come, right? If that happens, then it means that there will be a continuity in the policy and there will be certainty for the people. Now FIIs especially, they want certainty, right? If they get certainty, they'll pour more money because they know that things of any black swan things happening is very rare, especially from the policy front, right? Because that's where a lot of things can change. But if the BJP government comes into power in 2024, then it will be good for the market because there will be policy continuity, and they majorly are focused on the growth part, right? So that is where I think that FIs can probably become a net buyer in the days to come, because they have been selling left, right, and center all this while. But post this election, if you actually see the FII's figure, so you can see green bars. So see, all this while you had this red bars, which means they were selling. But post the election outcome, they have started to pour money in the Indian markets, and this can continue, and which means that there can be a case where small and the mid caps actually underperform and the large cap does well, because FIs put their money largely in the large caps, right? So that is on the small mid caps and the large caps. So even in the small cap index, we have a very similar count. Like I showed you in the mid cap, this is 1, 2, 3, 4, 5. In fact, it is a very sort of a ditto chart that we see in the mid cap, that this is 1, 2, 3, 4, 5. So over here, whenever the correction kicks in, you can see a meaningful correction, and probably only then the things start heading higher. And one more thing, what is very much visible right now is that the RSI is coming to the overbought zone once again. And whenever we have seen RSI readings go above 80 or so, eventually there is a correction, right? So again, over here, the thing to flag that is being that is what we are getting it from the technical indicator, right? But so far we don't have a price confirmation, and we will wait basically for the 20-day average to break to get that confirmation. Because if things turn around, it will be something like this, and meanwhile you will see the averages also coming higher. And once the averages break, that's where you can expect some bit of correction in the days to come. So yes, so that's broadly on the Indian indices and the global indices, and the important ones which we track, that is gold, silver, and dollar index.
That's very interesting. Thank you so much for that, Jay. I'm very keen, in fact, on checking with you if there's any important observation in the sentiment data on strike, Jay.
Yes. So, we were talking about this last week, that, there are many data points that we are observing. So in the short term now, once again, we are seeing some sort of fatigue at higher levels, because you can see that the Nifty index is rising higher. But again, the daily swing, that has been dipping a bit from the past 2 days. Also, when you see the average swing, it is a similar case where, it has rolled over a bit. So that is also one thing that we are seeing. Now, again, whatever we speak about sentiment indicators, those are all things, that may show a red flag, right? So I was checking many of them, and they are actually showing a red flag. But like I said, price reversal is very important for that. So as long as the averages hold on the hourly chart or on the daily chart, they are okay. You can expect some bit of correction, and then again you can see those prices also rising higher, and sentiment indicator, like after dipping a bit, they can again start rising higher. So that is something that you have to be very clear about. But yes, one more important thing, which is actually in the favor of the bulls, is that if we see the FII data, okay, I mean their positioning in the index futures. So this is what we had talked about, that they were extremely short on the market, and despite market rising higher, they were not cutting their position. But in the past 2 to 3 days, they have significantly cut their position, and now the short position has come to minus 3,000 or minus 4,000 contract from minus 1,74,000 contract or so, which they were there. Now we have to go to plus 60,000 or plus 90,000 sort of contracts, and that is something which is still very much supportive for the Nifty index in the days to come. So what may happen is that we might get some minor correction due to technical factors, but eventually it should head higher, till the time this FI positioning doesn't go to 60,000 or 90,000 kind of mark. Now when we look at the derivative data, so this was also something that we had discussed last week, that we should see this ratio inching higher. When this ratio inch higher, that means people are more comfortable shorting puts. And if people are more comfortable shorting puts, that means that the overall sentiment is bullish in the market, right? So if you see this ratio, it still has some more room on the upside, because I think on the upside around the 1.7 level or so, that's where it starts getting a bit overbought, and we then eventually form a divergence or so, and only then we correct, right? So once it comes to around 1.10 or so, you need to be a little careful. Right now it is 1, so there is still some more room left on the upside. Now if you look at many other diffusion indicator, okay, so they are actually hinting towards an overbought zone, because over here you can see that 98% of the stocks within Nifty 50 are trading above their 20-day average, right? So eventually there will be a bit of a cool off, and then when it starts rolling over, that means that many of the stocks are then breaking the 20-day average, right? And then eventually if the Nifty also breaks the 20-day average, that will be the point where weakness can start kicking in. But when we look at many other things like RMI, that is the percentage of stocks which are in buy for the Rohit momentum indicator, that you can again see that in the past couple of days that has started to turn down, right? Again, this is a red flag, but price confirmation will be awaited. But yes, I mean, if this ratio continues to head lower on the downside, and if we get a break of the 20-day average, or even in the hourly chart, there is a break of the averages, then we can expect some bit of correction. Because like I highlighted earlier as well, the hourly RMI of the Nifty is in sell mode right now. So, just to recap it once again for the people, if we see the Nifty hourly chart, the RMI currently is in sell mode, and we are sort of seeing a negative divergence as well on the RSI, which indicates that the momentum on the upside is losing, right? But it's only when the first confirmation of a cool off will basically be a close below the 20-hour average, and which right now the 20-hour average is around the 20,800 sort of mark. Once that is broken on the downside, then that's where you can see at least a case of a near-term correction. And whether that near-term correction translates into a bigger correction or no, that will be an evolving thing that we will keep updating to the viewers. And that is something that we already we update every day through our newsletter, through Indiacharts. And see, one more important thing that people can watch out for is basically the India VIX, because all this while you can see that the India VIX was not sustaining about the 13.8 mark. Right now we are somewhere over there. So broadly, if we take the round figure, so it is the 14 mark. If the India VIX starts sustaining above the 14 mark, that will mean that there can be an increase in volatility. An increase in volatility usually leads to, a sort of correction in the short term. So this is one more factor that we are watching out very closely. Okay, apart from the sentiment data, which we discussed. But yes, I mean, if we look at the many sentiment data, to summarize, it is the FII data which is much more favorable from a positional perspective. But many of the other things, they sort of indicate that there can be a near-term correction, right? Whether that near-term correction translates into a bigger correction or no, that we need to see. But yes, that is how it is. I mean, you can expect some bit of correction in the near term, but eventually there are no signs to say that we are topping out or something like that.
Wonderful. That was very well explained, Jay. Thank you so much. And viewers, if you do have any more questions, you please feel free to ask Jay. Send us a comment on the YouTube video and we'll be more than happy to answer. Okay. For those of you who find strike interesting, as Jay explains every week, what the sentiment indicators are saying, we have got upgraded features on strike very often. I would urge you to go on to the link that I'm going to leave on the description. You get a free sign up right now. So have your free trial with Strike and check the features of Strike yourself. And also follow Strike on Twitter. So we have got daily updates on our Twitter Strike. Okay. I'm going to leave a link down for you as well, so that every day, whatever updates you want on the stock market, we have readily available there. And also follow us on the YouTube channel on both the platforms. Thank you so much, Jay. That was a very interesting market insights we had today. And we are going to see, both of us are going to see you next week. Yeah. Take care of yourself, guys. Thank you.